Good morning, everybody. I wanted to talk to you today a little about what's going on in the U.S. economy, inflation, the war in Ukraine and Russia, and how all those different things really do make a big difference for the real estate industry. So to start off with, Federal Reserve did meet this week, and Jerome Powell spoke yesterday about their plans. Many had hoped to learn more about their plans for the rate hikes, how many they're going to be, as well as what they're going to do with their balance sheet. You know, they've been buying $120 billion worth of treasuries and mortgage-backed securities this year. So what are they going to do with that, and how will that affect interest rates? So first off, I want to bring it back 1 month ago, where a lot of people in this industry were worried about rates hitting 3%, 4%, and what that's going to do to everybody. Well, since then, war broke out, and then investors flocked immediately to the bond market because that is a safe place usually to invest in times of economic uncertainty. Should have been better for interest rates. Well, their positions fairly quickly changed when they started worrying about inflation and oil prices and what this can do long term. So since then, we have hit 5% interest rates. Yes, I'm here to say we're in the 5% range, but let's keep that in perspective a little bit. 5% is the industry average for the history of mortgage rates. So we've just been spoiled, to put it short, for the last few years. As far as the plan going forward for the Federal Reserve, Jerome Powell said that it will be very similar to last time. Last time was in 2018, and what had happened then was they raised rates too quickly, the economy slowed, and then they had to bring rates back down to reach some stability. Kind of like flattening a piece of plastic, bending it back and forth until it's flat. Well, a couple things that the Federal Reserve can do to manage inflation as their number one goal right now. They can raise rates. Yes, they raised it 0.25% this time, and they talked about 3 this year, 4, and now it's 7 times. Many people doubt that they'll have the ability to do this because of what it will do to our economy and slow it down so much and hit a recession, especially in terms of max employment as their other goal. So another factor besides rate hikes is quantitative easing. This is what they did, buying all those mortgage-backed securities and treasuries. We wanted to figure out how and when they're going to make some adjustments here. And pretty much all the Powell said is we'll talk about that next time, but they are close to a plan. One thing I want to mention though is that adjustments to this are just as effective as adjustments to rate hikes. So watch out. More of these could equal, as opposed to 7 rate hikes, it could be like 12 depending on what they do with these quantitative easing, on their balance sheet. So what they did indicate is that they're more or less going to let them roll off. $60 billion is usually reinvestments. So they're going to stop that and just kind of slow their purchasing program. To talk about the war in Ukraine, wars can be very inflationary, as you can already see with the oil prices hitting $130 per barrel. Supply chains messing up even further, so that could cause more inflation. And so let's talk about inflation as a whole. Inflation is bad for interest rates because it decreases the bond investors' return of investment, so they typically would not like to invest in this situation. The bond market directly correlates with rates as well, so anytime there's a change in the bond market, there's a change with rates. Now, what's happening with inflation, there's too many dollars chasing too few goods. How did this happen? Well, with COVID, a lot of layoffs happened. There was not a lot of production, but there was a lot of stimulus hitting people's bank accounts. So they weren't working, but they were making money. They weren't producing goods and services. And now we have too many dollars chasing too few goods. Shock to me, the Federal Reserve says that their plan for the end of 2022 is to decrease inflation down to 4.3%. Right now, it is 7.9% for CPI. This is the cost of living index most people look to. It has reached a new, fresh 40-year high, month after month. So this isn't a surprise to anybody. And the last time it was as high was the 1980s. So excluding food and energy prices, core inflation rose 6.4%. And I really want to break this down to the average consumer. So real inflation adjusted earnings fell 2.6%. What that means is even though wages grew 5.1% this year, compared to inflation at 7.9%, we are still in the hole 2.6% year over year. So if we really want to talk about different things, if inflation was weighted how it was back in the 70s, it would look a little bit more like 14% inflation. All right, so as it pertains to the economy, Jerome Powell yesterday was speaking a lot of positive things about the economy. He was saying that, job demand is higher than ever. There's a higher savings than ever. There's very high hopes for GDP and unemployment rates from him. Well, if we look at the truth here, we've hit a 52-year record low for unemployment, along with a 40-year record high of inflation. People really aren't going back to work. So the economy is slowing, inflation is rising, disposable income's down, savings down, as they were very high last year with all of the stimulus. Consumer confidence is down to a 10-year low in many reports. New and pending homes dropping, retail sales is down, home builder confidence is down, but recent home starts are up. So that is a really good thing, as we really need more inventory. Basically, 70% of our GDP is made up of consumer spending, and this has really declined since mid-2021. Rising inflation along with a slowing economy equals, in one word, stagflation. So that is a big worry for a lot of people right now. This environment, along with that, the Fed is expected to raise interest rates. So they have a very tough job ahead of them. How do they manage all this? To get off of the economic portion there, as far as just the housing goes, Zillow market report came out, so I'll say it with caution. They said 730,000 homes are on the market right now. Compared to 2021, that is down 25%. Compared to 2020, it is down 48%. Long story short, we need builders. Since 2008, builder activity has been at extreme lows. Millennials are hitting prime home buying age as they're getting the families in the 30s. Rents are rising along with appreciating houses. So really, there's a lack of rentals. We just need more places to live all of a sudden. All this, really makes a big difference for our economy and what we can do. Really, I hope that American workers can return to the workforce and the Fed can navigate these tricky waters to the best of their abilities. I'm in their corner, we might as well. To close it out today here, guys, we're still in a very good housing market. Yes, interest rates are average. The cost of homes are higher because we need more places, but it's not going to hurt anybody to own a home. In fact, it will be a very safe bet to own a home right now because you have equity in your home. That equity can be used during times of economic uncertainty to pay off other debts that are higher than 5%, whatever you can get in the market right now. So it is still a very good idea to own a home as long as you have a strong projected outlook for your career. Any other questions on how these affect rates and what you can expect, please give me a call and we'll talk to you soon. Thanks.